Market recovers from opening lows to trade flat despite a weak handover coming in from Wall Street following the August jobs report. Banking stocks trade with slight gains. The mid-caps are relative underperformers with cuts of nearly 0.2%.
Godfrey Phillips shares slip over 5.5% after shareholders approved the reappointment of Beena Modi as the company's managing director.
Ola Electric skids more than 3%, down 4% now as the post-IPO one-month lock-in period ends today. Nearly 18.2 crore shares are eligible for trade now.
Deep Industries has hit a 52-week high, surging over 17% after it has won an order worth over 1,400 crore rupees from ONGC. The order value is almost half of the company's market cap.
The new kid on the block, we have Gala Precision Engineering seeing a strong debut at a near 36% premium was the listing. The stock now trading at a 43% premium to its issue price of 529 rupees per share. Hello and welcome. You're watching us here on Chartbusters. I'm Mangla Malu. With me, Hormaz Fatakia. We saw the markets open with deep cuts. At one point, the Nifty was down by almost 100 points as well. But from there, we've seen a recovery, and the recovery has been led by Nifty Bank, which was an earlier underperformer, currently sitting mildly in the green. So one green block is what you can see on top of our heads, as against the three red ones, and the mid-cap index being a lot more in the red. The
mid-cap index is in the red. Firstly, welcome back to you, Mangalam. It's not a pretty-looking screen if you look at the sector-specific indices. Although the Nifty has recovered from the lows of the day, the PSU banks continue to sell off from where they left off on Friday. The index was down 4% on Friday. It's down 1.5% as we speak. The small-cap index is also down 1.5%. Losses also coming in from metals, and the one pocket barring the PSU banks is the overall PSU space as well. The Nifty PSE index, if you could pull that up, that index is also trading with losses of almost 2% now as we speak, and all 20 constituents of the PSE index now are trading with losses, but lots of primary market action to focus on as well in today's session.
Indeed. So let's talk about Cross, a company that is in focus. It manufactures and supplies trailer axles and suspensions, opens its 500 crore rupee IPO for subscription today. Will close on the 11th of September. We're joined by Sudhir Rai, who's the CMD of the company, to discuss the opening and strategies post their launch. From the 500 crore issue that you've launched, 90 crore is slated for debt repayment. So that leaves us with a two-part question. One, what is the current debt on books? And post this repayment, what will be the delta on your finance cost? Because that will then directly flow down to your bottom line.
Yeah, hi. Thanks. Good morning. So our total debt is 128 crores. This includes short-term as well as long-term. And we will be paying back 90 crores from our IPO proceeds and the balance amount. So there will be our cost of funds as of our last financials was about 2.2% of our top line. So this will have an effect of at least 1.5% on our margins.
Mr. Rai, good morning. Thank you so much for joining in. Congratulations on the IPO. And I'd like to ask you that you're planning on acquiring and on equipping your existing manufacturing facilities as well. Is there a capex plan that you plan on incurring from that? And how do you plan on funding that capex? And by when does all of this come on stream and the resultant synergies of that as well?
Right. So yes, we have plans for capex also. We have a plan of 70 crores from the IPO proceeds to go into capex. So we are now in this business of trailer axles and suspension, which is a new part which we have added just 4 years ago. And this very short span of 4 years, we have become a major player in this segment. So we would like to spend money on this in this particular segment. 30 crores of our 70 crores would go into the trailer axles and suspensions, where we plan to bring in newer technologies, technologies of extrusions, which are currently being fabricated in India. This not alone, we plan to spend about 22 crores in our forging setup, which will go into increasing the general capacities of our factory. And also in the exports, which we are also planning right now, we will be spending close to 18 crores in that segment.
All right. So, just a question to understand how this will reflect in your revenues. The 70 crore capex that you're doing, what are typically the asset turns across the capacities that you are, laying down? And as a result of which, what could the incremental revenues and revenue mix look like? Because you said that you are also increasing some capacity towards exports. Now that accounts for just about 1% of your sales. How much does that increase by going forward? So part one is increased asset turnover because of this capex that you're doing. And secondly, export. How does that change?
Yeah, we have a very good asset turnover ratio of our factory. It's 3.5, 3.6x, which is a benchmark, you could say, in any industry. And going forward, maybe a year, we will see a small dip. But otherwise, long term, we will continue to maintain such margins, such ratios. And
70 crore capex that you're doing will give you additional revenue of close to around 200 crores, right?
70 crores capex will allow us to grow for the next 4 to 5 years, especially our main backward integration of extrusion as well as from the forging capacities which we set up. We also plan to increase our foundry setup by putting up a second line. So going forward, we plan to grow in a similar trend which we have in the past 2-3 years.
Could you quantify that revenue potential, Mr. Rai, and also that 70 crore capex that you're talking about? How would that reflect on your margins as well once everything comes on stream?
So our current margins, our PAT margins are at 7.2, and this PAT margin also has grown sizably in the past 2-3 years. So going forward, we see the same growth in our PAT margins.
All right.
Yeah, please go ahead.
Yeah, I look at your margins. They've increased from what, 9% all the way up to 13% in the period that you've reported in your red herring prospectus. What are the other triggers for margins and what do they settle at? This is the EBITDA margin that I'm talking about. Can we look at somewhere closer to mid-teens? Because some of your peers are very close to that 20% mark as well.
Some are closer to 20%, some are closer to 5% also.
Right. So
and
let's talk about where you would want to go then.
We don't want to go there. So margins, you see, if they keep growing, is because we are backward integrated in a very big way. Okay, we have a forging umbrella under us. We have now a foundry. We have all the machining operations, and we spend in manufacturing. This new technology of extrusion, which we want to bring in, is going to be the first of its kind in the country. And it will be a better technology. It will be a stronger product. It will be a more cost-effective product. So we spend money in technology, and that's how our PAT margins and margins grow year over year.
Clubbing two questions into one, Mr. Rai, due to paucity of time. Part one being, what is the kind of demand that you're currently witnessing across your business verticals? Part one, and part two is almost 2/3 of your business comes from your top 5 contributors, top 5 customers. Is there a plan to bring that number down as well?
See, we are very happy with our customer base and how we have spread it out. Okay. We want to grow with each of our customers. And coming to your first question, what was it, please? Can you just repeat it?
I wanted to ask you, what are the kind of demand trends that you're witnessing across your business segments?
Yes, one or two demands basically which we are spending forward. One is on the exports, which I have not yet touched upon. We have tied up with 2 major export partners, and we see a big demand for auto components from the rest of the world. That is one aspect, and the demand within the country for the trailer segment is growing phenomenally. That is because there is a major shift from rigid vehicles to going to your prime movers. And this, all the OEMs also are aware of.
Right. Since you touched upon exports, Mr. Rai, very quickly, it's currently only 1% of your business. Would that go up to say around 5% or maybe even double digits, say in the next 3, 4, 5 years?
Yeah, 5 years, definitely it's more than double digits. manage. Yes, that's what.
All right, Mr. Rai, we leave it at that. Thank you so much for joining in. Wish you good luck for your IPO. Looking forward to conversing with you on your listing day as well. That was the management of Cross. The IPO opens for subscription today. Shifting focus now to our special segment where we get you a few ideas for profit from Money Control Pro. Bharat Gianani of moneycontrol.com joins us now to talk about a stock that he is tracking closely.
Today's idea will be Sandy Hotels Limited. The company posted better than expected quarter one performance. While the same-store sales growth was subdued owing to the Lok Sabha elections as well as heat wave, the company posted better than expected margin performance. Integration of the ICICI portfolio as well as cost control measures led to better than expected margins. SAMI's balance sheet has improved significantly post the IPO last fiscal. With a strong balance sheet as well as a healthy cash flow generation, the company's focus has now shifted to growth. The company has highlighted inventory addition plans of 10 to 15% every year. The company has highlighted plans for adding rooms in existing properties. Apart from that, the company will be acquiring new properties as well as adding properties on a long-term lease basis. Apart from that, the company is rebranding about 10% of its overall inventory, which will also aid in the overall growth momentum. There is scope for margin improvement from the current levels, given the integration of the ICICI portfolio and better pricing due to the demand upcycle in the industry. The hotel industry upcycle is expected to continue over the next few years, which will be beneficial for players like SAMI. At the current market price, the stock is trading at an EV by EBITDA of 14.7 times after 26 projections. We expect the valuation multiples to re-rate and hence recommend investors to add the stock in the portfolio.
All right, with that, we'll take a short break, come back on the other side. We have a rare conversation. Amit Dhanuka, who's the Chairman and Managing Director of Tilak Nagar Industries, joins in to discuss the company's business outlook, the likely impact of the new liquor policy in Andhra as well. Stay tuned for that. Welcome back. Let's talk about Tilak Nagar Industries. Why is that? Because news reports suggest that Andhra Pradesh is likely to bring in a liquor policy similar to the Telangana one, where retail liquor businesses will be handed over to private parties. To understand this, the impact of this new policy and get an outlook on the business for that, we have Amit Dhanuka, who's the CMD at Tilak Nagar Industries, joining in. Remember, 85% of their revenues do come in from the southern part of the country itself. Thanks a lot, Amit, for joining in. The regulation question out of the way. One, how much of your sales actually come in from Andhra and Telangana? And were this policy to be announced, basis what you're hearing, what could the impact on players like you be?
So at the outset, thank you for having me on the show. We're very pleased to be here this morning. So we have, as you mentioned upfront, about 85% of our revenues do come from the southern territories. Andhra and Telangana account for around 50% of our total revenues, with Andhra Pradesh being around 30%. So with the change of government, with the recent elections, which concluded in June, we have been expecting, in fact, the government has made an announcement that there would be a new policy effective October 1. So we are also curious as to what this new policy would be, but going by the track record of the leadership, we do expect it to be fairly progressive, which will be forward-looking, for the next 5 to 10 years, and will provide a level playing field for all national parties as well. So we are quite optimistic as to what the policy would be, but to really elaborate on the contours, it would be too premature right now.
Amit, good morning. Thank you so much for joining in. In a hypothetical scenario, if this policy does come into place, what kind of an impact would that have on your company's volumes? And if you can couple that up with the overall business in general for the current quarter, what are the kind of trends that you're witnessing on the volume front so far?
So just to put it in perspective, I think in the last 5 years, if you see the 2019, when there was a regime change in Andhra Pradesh, the exit volumes in 2024, we see that Andhra Pradesh hasn't really grown in terms of the overall market opportunity. There hasn't been much change in the Andhra Pradesh market in terms of volume. Whereas in that same period, if you see, Telangana would have significantly grown, huge change in the Telangana business opportunity, whereas Andhra has remained stagnant. And we see no reason why, that should have been the case. So I think it would be fair enough to say that if there's a policy which provides a level playing field for all participants, is progressive in its outlook, There have been talks of perhaps privatizing the retail trade as well, though I think they're unconfirmed reports. We can't say with any level of uncertainty. Currently, the route to market is that the shops in Andhra Pradesh, they're government controlled, government operated, whereas the on-trade business, which is the bars and the restaurants, of course, that is private. There have been murmurs that the trade could be privatized, and I think the opportunity could be fairly large. So
Right.
but really to quantify what type of impact that would be, it's quite difficult to say. But
Got it.
Andhra is one of our key markets.
So for one to make a reasonable comparison, you did allude to the fact that from the exit of the government change, Andhra has remained stagnant, whereas Telangana
Fairly
has seen a
stagnant.
big growth.
Yes.
Right. So what is the delta between the two, if you could give us a sense, over the last few years?
So I would say if the Andhra growth has been largely flattish, whereas Telangana would have grown probably mid double digit over 5-year CAGR.
So if this does come by, would it be safe to assume that given the base difference, etc., growth in Andhra could be, say, high single digits or lower double digits as well over a 5-year CAGR?
Yes, we would certainly expect that. We would certainly expect that with the right support and the right infrastructure, the right policy, we would, I think, certainly expect that. The leadership has been known to be progressive. I mean, going by past record, we have seen that the leadership has been progressive in terms of its outlook towards industry as a whole. I'm not specifically mentioning the liquor industry, I think, but quite supportive to industry as a whole. So we can be fairly optimistic at this stage.
Coming back to the question that I had asked you, Amit, earlier, what are the current volume trends that you are witnessing in this quarter, and is there a target that you have set to end the year with as well?
So I think we would end this year with a double-digit growth. I think that's what the expectation is. Of course, the quarter one, in fact, in quarter four itself, we had given guidance that owing to the ensuing national elections and state elections in Andhra Pradesh, growth would be muted due to a lot of policy regulations and restrictions during that time period. So quarter one for us was largely flattish, but I do expect it to recover also. At the current time, one must understand that while the new policy is going to be announced, there's a lot of flux and uncertainty in the market, which is continuing even now. But I think long term, the trajectory looks very positive. I think a month or 2 months, here and there could be some minor hiccups. But if you look at a trajectory, say for a 5-year period, I think we are very hopeful.
Mid double-digit growth is what you targeted in terms of volumes, and value would be about 300 basis points higher than volume growth. So should we see somewhere around 18 to 20% sort of revenue growth for this year, given how things are?
Yes, revenue growth will certainly outstrip the volume growth. I think that's been the trend. I think that's largely due to the product mix and the state mix also, which we have run. So I do see that to continue in this year. And we'll have margin expansion also. In fact, the first quarter margins itself was around 14.5%, which is typically it's our weakest quarter. It's typically the beer sales are very high in the first quarter. Our sales are little sluggish compared to the remaining quarters. So, going by that trend, I do expect that 14.5%, which we have reported for quarter one, that will kind of form a base now.
All right. So 14.5%, this is ex-excise. The reported margins are close to around, ex-subsidy, the reported margins are close to around 16% right now itself. Just a final question before we let you go, with a promise to join us back once the policy is announced for a much detailed conversation. Your product mix is something that you alluded to. Going forward, currently about 94-95% of your revenues come in from brandy. Going forward, what is this mix likely to be, say, over the next 1, 3 and 5 years? And in brandy as well, flavored brandy, Flandy as you call it, has been gaining some traction. So how much would that account for in your overall sales?
So Flandy, I think now in the states where we have currently launched it, it accounts for around 10% sales of the mother brand, which is fairly good now. Entering the second year of launch, it's something which we're quite happy of, something we're quite proud of, the progress it has made. In the next 1 to 3 years, I think, the brandy volumes will still dictate the growth which we will have. I think there's a lot which we are currently planning to do also in terms of brandy, in terms of certain new launches and new flavors which we plan to introduce. So brandy will continue to dominate our product portfolio for the next 1 to 3 years. But if you take a longer term horizon, say the next 5 to 7 years, I do believe that we would look at opportunities in flavors other than brandy also, strategic opportunities, tactical opportunities, geographic-based opportunities. So we'll be quite selective and guarded in terms of our foray into flavors other than brandy. But yes, I mean, the company now is moving September. By March 25, we do expect to be net debt free. So we will have, cash generation, which will allow us to subscribe to, various growth opportunities in categories other than brandy as well.
So you're looking to make inorganic acquisitions in the second half of this year is what we've read from what you've said so far. Though I know you won't comment on specifics and say that we're always on the anvil and looking for some opportunities. We'll hear from you and also speak to you once the policy is announced. Not too far from now, you're saying October 1. So we'll get you back on the show. Always a pleasure speaking with you. Take a short break, come back, get you more on the markets and a lot of stock-specific action. Stay tuned.
Back with us on Chartbusters, the recovery from the lows of the day continues. The Nifty has now slipped into the green, now is headed into the green. The Nifty Bank continues to surge, now almost 400 points off the lows of the day and is now at the highest point of the day, now nearing levels of 5,800. The broader market still in the red, but better compared to where they were at the start of the show. But with that, it's a wrap on this edition of Chartbusters. From Mangalam, me and the team that put this show together, thank you so much for watching. Trading Hard takes the action forward.